Swayam Prabha. Digital India. Educated India.
Welcome dear learners to the session of Managerial Economics. I am Dr. Supriya Jain, working as an assistant professor in the Institute of Business Management at GLA University, Mathura. Let us start with our today's session. Before we talk about our today's class, let us look at the topics which we have covered in our previous session. So, in our previous session we have talked about consumer choices and their behavior. As because it is important for us to know how consumers are making their choices, how they behave in the market. So, through that we have discussed about their taste and preferences, their choices, where we have talked about cardinal concept as well as ordinal concept of utility. Marshall gave this cardinal concept and says that utility can be measured, and utility is the satisfaction which a consumer derive out of the consumption of a commodity. So, this cardinal concept is basically based on two laws, where we have talked about law of diminishing marginal utility and law of equimarginal utility. Law of diminishing marginal utility works with only one commodity at a time, whereas in real life a person does not consume only one commodity at a time, but consumes more than one, so as they would be able to satisfy their needs and desire, as well as to gain maximum satisfaction out of it. So, for that we have also talked about law of equimarginal utility, which says that the marginal utility derived out of the consumption of all the commodities at the end should remain same. Thereafter, we have talked about this ordinal utility concept, which was given by Ellen Hicks, and in this we have seen the indifference curve relativeness. Okay. This indifference curve is also called as iso-equality curve, right, iso cost curve. So, this curve basically help us to understand how people can have the different combinations of the commodity, so as their utility will remain the same. Okay. And in this we have also discussed the different indifferences curve. Okay. After the properties we have studied it into the different situation, like for perfect substitute goods how indifference curve will be shown, for complementary goods how we represent this indifference curve, and for the situations like bad. Okay. So, all these things were covered over there. And then we have talked about the consumer income, because this is basically helping the people to understand how much they can spend based on their budget line, and when a consumer will be able to reach out the equilibrium position, right. Equilibrium is basically the state of balance, and a consumer will reach up to the equilibrium point where the consumer is able to spend the resource, that is the income, right, which will be giving them the maximum satisfaction. And lastly, we have talked about this revealed preference theory, which was given by Samuelson, and based on this theory we can say that utility can be measured in a better way as compared to the cardinal and ordinal concepts. And here consumer reveal their preferences, and they have the completeness of their choices, where they are very much clear which product they are going to prefer. Like if there are two products, product A and product B, so which products are they going to prefer? If they are preferring A over B, then always the person will prefer commodity A over B, right. So, these were the topics which were covered in our previous session. Let us look at the topics, or you can say the learning objectives of our today's session. So, firstly we are going to understand the meaning of cost here in economic analysis and its relevance in managerial decision making. So, particularly in this lecture we are going to talk about the cost, what different type of costs are involved into the business, and how managerial decisions making can be done better, right. And here you will also able to understand the different type of cost which focus on difference between economic as well as accounting philosophies. Further, you will also able to analyze the importance of matching cost with the relevant time frames and to understand the short and long run cost, right. And lastly, this will help you to develop an understanding of estimation of cost function. So, these will be the learning objective of our today's session. Let us look what cost is. Now, this is the term which everybody of you must have heard, because everything involves cost. So, how we are going to define this cost? We can say that cost is basically a sacrifice, right. Cost is a sacrifice which you are making for buying something or for producing something. So, here we can define that cost is a sacrifice or foregoing that has occurred or going to occur, right. It has occurred if you have done that production, and whatever you are going to produce in the future. So, what cost is going to be involved, that is been measured in terms of money, and that is why we have written here measured in monetary terms. So, if you look at the cost function, we can say that cost is equals to the function of Q is the quantity, T is the technology, and price of input factor, right, as because quantity, the more quantity will be there, the more cost will be there. So, cost is affected by the quantity of the commodity, cost is also affected by the technology, right, better the state of technology, lesser will be the cost. And then we have price of inputs, definitely if the input prices are high, cost will also be higher, right. So, cost basically depends on different factors also. So, these are the most important factors which affects the cost of the commodity. So, if we need to define the cost function, we can write it this way, where cost is the function of quantity, technology as well as price of the input. Now, moving ahead, we have cost analysis and classification. This is important, right. How are we going to analyze the cost and how differently we are going to classify it, how many categorization we can do in the cost, right, because as we have different type of cost in the businesses. So, here we have made our classification into different categories. So, let us first understand what is meant by cost analysis. See, why cost analysis is important, because as we know in today's time we have lot of competition, right, and it is very difficult for the producer to increase the price of the commodity to earn more. So, the only choice they are left with is to reduce the cost of their commodity or to reduce the cost of the production, right. If they want to increase their profit margin or if they want to have long term survival in the market, then it is very important for the manufacturer to analyze the cost, what are the different type of costs which are involved in the business and how they will be able to reduce these costs by their understanding, right. So, cost analysis basically refers to the study of behavior of cost in relation to one or more production criteria, namely the size of output, scale of operation on which they are working, price of factors of productions as well as other relevant economic variable. So, all these aspects are being taken up into account to understand different type of cost involved into the business. So, here we are going to have the categorization of cost, and we have categorized the cost into explicit and implicit cost. The first category is, secondly we are going to understand about incremental cost and sunk cost. Then we will discuss direct cost and indirect cost, controllable cost and non-controllable cost, and thereafter we will discuss shutdown cost and abandonment cost. So, how are we going to understand these different type of costs? Let us start with the very first one, that is the explicit and implicit cost. Now, what is explicit and what is implicit? Explicit, the name will help you to understand the external cost, right, the cost which we are paying to the outsiders, right, all those costs would be considered to be an explicit cost, whereas implicit costs are those costs which we are not paying to anybody, right. So, let us read the difference between the explicit and the implicit cost, you will be able to understand it better, right. The costs which are either paid in cash or recorded in the books of accounts are called explicit cost. So, here we are talking about two things, the cost which are being paid to someone, like we are paying salaries, like we are paying for the raw material, right, whatever we are making, whatever the payments we are making, right, to anyone for the services they are providing, for the work they are doing in the business, that particular cost and the cost which we are recording in the books of accounts, like depreciation is there, okay. Whatever the assets we are having, they depreciate every year, right. So, by what amount they are depreciating, we show that amount in the books of accounts, right. We are not paying this cost to anybody, but every year our machineries, our assets are depreciating, right. So, that particular cost is also a part of an explicit cost, right. So, here the examples are written like wages we are paying to the labor, the salaries which we are paying, the cost of purchasing the material or the license fee if you have taken any license for doing your business. So, all these costs are the example of explicit cost, whereas implicit costs are those costs which you are not paying to somebody, neither you are mentioning them in the books of account. That means these costs are there, but they are not being recorded anywhere and we are not paying these costs to anybody. Now, you will wonder what are these costs? Now, whatever the cost, if we are not paying to anybody and if we are not mentioning them in the books of account, then how we are going to understand what kind of cost they are? I hope students you remember the opportunity cost concept which we have studied in our initial classes, where I have told you that opportunity cost is the cost of sacrificing the next best alternative, right. And in economics we are not only concerned with the accounting profit, but we are concerned with the economic profit, right, whether we are in economic gain or economic loss. So, implicit costs are basically those imputed costs which are there, which we are not paying out of our pocket, but yes, if we are doing this thing and we could have done something else, then definitely we would have been able to earn something on those particular alternatives, right. So, what are these implicit costs? Implicit costs can be like if you are using your own building for your business purpose, right. Whatever the business you are doing, if you are doing it on your own property for which you are the owner, so those costs, those type of costs would be considered to be an implicit cost, because you are not going to pay rent to yourself, right. But if you were not doing the business on your own land, if you have given this land to somebody for rent purpose, right. So, you must have earned that amount, okay. So, the amount which you could have earned as a rent, which now you are not able to earn because you are doing your business on your own property. So, that amount would be considered to be an imputed cost or implicit cost, right. Whatever the capital you have invested, okay, if you have taken that money from the market, definitely you would have paid interest on it, but your money which you are investing in your business, you are not charging any interest on it. So, that is the cost which is called as implicit cost, right. These costs are the costs which we are not paying to anybody, nor we are mentioning them in the books of accounts. So, I hope the difference between explicit and implicit cost is clear, right. Explicit costs are those costs which are being paid to the outsider as well as are also being recorded in the books of accounts, whereas implicit costs are those costs which we are not paying to anyone and nor we are mentioning them in the books of accounts, right. Now, moving ahead, we have the another category where we have incremental cost and sunk cost. Now, what are these incremental costs? Again, we have talked about this incremental cost when we have studied about the incremental cost principle. Whatever the decision we are making, whatever the change we are making in our business, and because of that change, the increased cost would be called as incremental cost. Either if you want to add new product to your production line, or you want to increase your production capacity, or you want to add some more promotional strategies to your business, right. Whatever the change you are making in your business, and because of that change, right, if your cost increases, then that increased cost would be called as incremental cost, right. And if you will not bring those changes, then definitely that cost will not increase. So, sometime we also call these costs as an escapable cost, because we can escape from them, right, because they are future oriented. If you are going to make that decision, then these costs will incur. If you are not bringing that change, these costs will not incur. Whereas, opposite to it, we have sunk costs, right. Now, sunk costs are those costs which are related to the past, okay. They related to the past, because this is the amount which you have already given to somebody, right. Suppose you have given some amount to someone and that person declare himself as an insolvent, right. So, how will you be able to recover that amount? Okay, bad debts are the examples of sunk cost, right. You will not be able to recover it again now. So, on the other hand, we are saying Sunk costs are those costs that do not change by changing the nature or the level of business activity because they are related to the past, like depreciation is also an example of sunk cost, or you can say amortization of past expenses, right. So, we are not able to recover them back, that is why they are non-avoidable, and you can also call them as a non-escapable. You cannot escape from these costs. Now, next is direct and indirect cost. Direct cost, very simple to understand, the cost which you can directly associated, okay, to that particular process or to the particular product, right, or to that department. Then if any cost is having a direct association, then those costs would be considered as an direct cost. Whereas, if you are not able to have a direct association with the product, process or that particular department, then those costs would be considered to be as an indirect cost. Like for example, right, a material used in a pen, okay, the pen which I am using right now, the pen, the material for which it is made of, right, of which it is made of would be a direct cost, okay, because we can easily calculate, like for manufacturing this pen, whatever the material has been used, the cost is a direct cost. Or you can say electricity expenses for painting the car is also a direct expense for painting process, okay, because it is a painting process, and whatever the electricity is being incurred for painting that particular car can be directly associated with that process, okay. So, if there is a direct relationship to it, then those costs would be considered as an direct cost. Opposite to it, we have indirect cost. Indirect costs are those costs which do not have a direct relationship, like for example, expenses for the gatekeeper at factory gate, okay. There is a factory, and on that, in that factory, on a gate there is a gatekeeper, but inside the factory you are producing pen, pencil, refill, ink, okay. So, you cannot associate directly this cost what you are paying him as a salary to any of these products, because altogetherly different kind of products are being manufactured, and he is there for taking care or as a security of your factory. So, whatever the amount you are paying him for the salary as a salary, there is no direct relationship with that particular product or a process or a department, okay. So, those costs would be considered to be as an indirect cost. Then we have controllable and non-controllable costs. There are some costs in the business which can be controlled through proper management and supervision, like cost of inventory. If you are managing your business in a better way, if you are supervising your things in a right direction, then definitely you can manage your inventory better and there will be a lesser cost. Like cost of labor, sometimes people waste their time talking to each other. If you are not taking proper rounds in your factory, if you are not supervising them, if you are not managing your work, right. So, might be these are the costs which can incur, but with your proper management and with your proper supervision, you would be able to reduce these costs, right. And that is why these costs are called as controllable costs. On the other hand, we have certain costs in the organization which cannot be controlled even with the proper supervision and management, right. Like for example, depreciation, every amount, right. Even if you are controlling them or you are managing them in a proper way as well, then also this depreciation cost will be there, right. They will definitely depreciate. So, those costs are called as controllable and non-controllable cost. And then we have this last categorization where we have shutdown cost and abandonment cost. Now, which cost would be considered to be as in shutdown cost? Shutdown cost basically arises when there is a temporary suspension of your business activity because of some reason, right. You are not working right now and temporarily you have suspended your business operation, but whatever the suspension has been taken place, that is for a temporary time period. So, during that period also there are some costs which are incurring, okay, like the cost of security of the plant and machinery, like staff layoff expenses can be there, recruitment and training expenses of the people when you are going to start it again, right. So, all these costs would be considered to be as an shutdown cost, whereas abandonment costs are those costs which will arise after the fully retirement of your fixed assets, right. If you completely closing down your business unit and for selling out your fixed assets, right, disposing of your fixed asset after the complete closure of your business would be considered as an abandonment cost. Okay. These cost arises when there is a complete closure of business activities, like for example, cost of disposal of plant and machinery. Now, you want to dispose them off, and for disposing them also you need to incur some cost. So, those costs would be considered to be an abandonment cost. So, if you are recalling it again, you can say that shutdown costs are those costs which arises because of the temporary suspension of the business activities, whereas abandonment costs are those costs which arises because of a complete closure of your business unit, right. So, these are the different categorization which we have made regarding the cost. If we go back, let me help you to understand them once again. Explicit and implicit cost, right. Explicit costs are those costs which we are paying to the outsiders or we are mentioning them in the books of accounts, whereas implicit costs are those costs which we are not paying to anybody nor we are mentioning them in the books of accounts. Incremental costs are those costs which are related to the future, they changes because of the change in the business activity, whatever the change may be, whereas sunk costs are related to the past and these are the costs which we cannot change, right. These costs have already happened, they are already sunk, right, that is why we are calling them as in sunk cost. Direct costs are those costs which have a direct association with a product or a process, whereas indirect costs are those costs which are not directly related to any product or a process. Then there are some costs which are called as controllable, those costs which can be controlled by proper supervision and management are your controllable cost, whereas the cost which you cannot control by proper supervision and management also are called as non-controllable costs. Then we have shutdown and abandonment cost. Shutdown cost arises when there is a temporary suspension of your business unit, whereas abandonment cost arises when there is a complete closure of your business unit, right. So, these are some classification and different type of costs which are involved in the business. Now, let us move to the very important part where we are going to understand the cost which occurs in short run as well as in the long run, and they are the most important costs for the understanding of cost and output relationship of business activities, right. So, let us start with the very first one where we have total fixed cost, or we can call it as in fixed cost also. So, fixed cost, as you can see, the name here is the fixed cost. So, these are the costs which remain fixed. Okay. So, the cost which remain fixed, which does not changes with the changes in the production, are known as fixed cost. Okay. Like for example, rent of a building or a factory, salary of a factory gatekeeper, depreciation of a machinery are the expenses of the fixed nature. They does not change with the change in the output, right. Your rent is not going to change. If you have taken a building on a rent, if you are producing lesser units in that particular building, then also you are paying the same amount. If you are producing larger unit of production you are making, then also you are paying the same amount of rent. So, there are some costs which does not changes with the change in the production. Those costs would be considered to be an fixed cost, but one thing which you have to remember here is this concept of fixed cost is applicable only in the short run, right. In long run there is no cost which is fixed in nature, all the costs are variable in the long run. So, this fixed cost concept is applicable in the short run only, right. For a period of time they are fixed and they does not change with the change in the production. This is how we represent the fixed cost curve. Here on the x axis we have output and on the y axis we have cost, and you can see this line which shows that the fixed costs remain fixed even if the output is 0 or we increases the output or we further increase the output, the cost will remain same, there will be no change to it, right. And looking to the next one, we have total variable cost, right. Now, again this word is helping you to know how we are going to define this variable, the cost which varies, right, which varies with the variation in the output, right. If you are producing more, then these costs will be more, if you are producing less, then these costs will be less, right. So, the cost which varies with the variation in the output would be called as total variable cost, right. And one thing which you need to understand for this variable cost is generally the rate of increase in the total variable cost remains different at different level, right. I will show you the graph where you will be able to understand it better. This is how we represent the total variable cost curve. You can see when the production was 0, the variable cost was also 0, but as and when we have started the quantity production, the average variable cost has also started increasing. But with this curve you can see that initially when variable cost increases, the rate of increase is lesser, right. Initially they increase at a lesser pace, then there is a kind of a stability there. They are not stability exactly, but they are also increasing at a very slow pace, and finally they increase very fastly, right. So, this is how we define this total variable cost. The rate of increase in the total variable cost differs at different stages. Okay. The next is total cost, total fixed cost and total cost. So, here we have written here is total cost is equals to total fixed cost plus total variable cost. If we combine them together, we get this total cost. Okay. So, for the production purpose, we calculate this total cost. What is the total cost of producing any commodity, including fixed cost as well as the variable cost. And this is how we represent all the three on the graph. Here on the x axis again we have output, and on the y axis we are representing the cost, and this is our fixed cost curve which shows the cost, these costs are fixed, they will not increase, whereas you can see the variable cost curve, this starts from 0 because these are the costs which will increase with the increase in the output, and from here we are going to start our total cost curve. This is the total cost curve which includes both, right, because always total cost is always involving the fixed cost and variable cost, right. So, up to this level we have the fixed cost at 0 output also. So, our total cost curve will start from this point, not from this point. So, this you have to understand, right. Then looking at the averages of these costs, we have talked about the concept of total fixed cost. Now, we are talking about the average fixed cost, and as we all know, average is basically we will be able to arrive at the average figure when we divide the total fixed cost upon the total quantity, right. When we are dividing the total of the fixed cost and how much output has been produced, then I would be able to get the average fixed cost. That means it is the per unit fixed cost, whatever the production you have made, if you are calculating the fixed cost per unit, then you are going to find out the average fixed cost. Okay. So, let us see the way we are calculating this average fixed cost. In this table you can see we have total output, we have total fixed cost, and here we have average fixed cost. So, how we have calculated it? The total output when it was 0, then also the fixed cost was 1000, right, and as and when the output is increasing, but you can see the total fixed cost is constant, it is not increasing, that we have already understood. The total cost, total fixed cost will remain fixed. But in the case of average fixed cost, you can see for the first case it will be no fixed cost, average fixed cost will not be there, but yes, when we have started our total output, in this case our average fixed cost was 1. What we are doing? We are dividing the total fixed cost by total output. Okay. In the second case, it will reaches 0.50 and then 0.33 and so on. So, what you can see here is our average fixed cost is reducing on a continuous basis as and when we are increasing our output, right. So, average fixed cost will keep on decreasing when there will be an increase in the output. Okay. So, this is how we basically represent the average fixed cost curve, right, and this is the shape which is also called as rectangular hyperbola, right, where it is representing that the average fixed cost is decreasing as and when there is an increase in the output. Okay. And if you see the rate of reduction in average fixed cost initially is higher and then it will reduce at the slower rate. Okay. So, rate also differs, it reduces, but initially it reduces at the higher rate and later on it reduces with the lesser rate. Okay. Now, moving ahead, we have average variable cost, right. Like we have understood the concept of average fixed cost, again the average variable cost is the variable cost per unit, right. If you are calculating the per unit variable cost of the commodity we calculated, and again for this calculation we can have the total variable cost divided by total quantity. Okay. So, you can look at the chart again here for the calculation of average variable cost. Here we have total output and here we have total variable cost, and you can see that as in when the output was increasing, our variable cost was also increasing, because that is its property. Okay. It varies with the variation in the output, whereas in case of average variable cost, when we have calculated and the same formula we are using, we are going to divide total variable cost with the total output, right. So, here are the figures of average variable cost, and here also you can see initially our average variable cost decreases up to this point, and now it has started increasing, right. So, up to this point it has decreased, but now here it has increased and here also it has increased. So, if you draw the curve for average variable cost, the curve look like this, right. Initially when you will increase the size of output, your average variable cost will decline, and then gradually it will start increasing. Okay. So, this is how you draw the average variable cost curve. Then again we have average cost, like we have calculated the total cost, we do have average cost as well, right, and average cost is again the summation of average fixed cost and average variable cost. So, if these two costs are given, you can calculate the average cost with these figures also. If not given, then you can calculate the total cost, and then again you will divide it by the number of unit produced, that means the quantity, then you will be able to calculate the average cost. Again average cost is the cost per unit, right. Whatever the commodity you are producing, per unit cost is called as average cost. Now, again this is the complete picture to make you understand how we have calculated. This we have already studied. This is the total output, total fixed cost we have seen, and we have also calculated average fixed cost. This is the total variable cost, and we have also understood how to calculate average variable cost. Now, you can see this average cost column, right. There are two ways, like I said, either we can add average fixed cost or average variable cost, then also we can calculate it, or we can divide this total cost upon the total output. So, here we can get the figures of average cost, and if you look at these figures, you can say that initially this average cost is declining, up to this point it is declining, and then at this point it has increased, and again at this point it has also increased. So, looking at this tabular representation, you can find out very easily up to which point we should produce, so that our cost of production should be minimum. See, the analysis which we are making here is for our purpose is to reduce the cost, and how are we going to find out up to which point, right, up to what point we should go ahead with our production, so that our cost of production will be minimum. So, you can see if you are producing up to 4,000 units of output, your cost of production will be minimum. If you are producing lesser than this, then also your cost will be more, and if you are producing more than this, then also your cost will be higher, right. So, if you want to produce up to the optimum point, you should be considering this average cost, where your average cost is minimum. That point is basically considered as an optimum point. Up to this point, if you are doing your production, your cost of production will be minimum, right. So, this is what basically we try to understand here. And how do we represent this average cost curve? This is how we represent the average cost curve. Again, this is of U shape, which says that when there is an increase in the output, initially it decreases, and then thereafter they started increasing. Okay. So, this is your average cost curve. Now, we have marginal cost, right. Marginal cost is again the cost, you can define that this cost calculated by finding out what additional cost has been incurred for the production of one additional unit, right. So, whatever production you have done, and if you are going to add one more unit to it, so for producing one extra unit, what extra cost you have incurred would be considered as an marginal cost. Okay, so, marginal cost is defined as an addition in the total cost because of change in one extra unit, right. This is important for you to note down. One extra unit of product, if you have added to it, and for adding that one extra unit, what extra cost you are incurring would be considered as an marginal cost. So, again here we have the ways to calculate this marginal cost. The simple formula is TCN minus TCN minus 1. N minus 1 means the one extra unit which you have produced, that you have to find out. And again there is another way where you can calculate it by finding out the change in total cost upon change in total quantity, right. And if you look further to calculate this marginal cost, you can see that change in total cost upon change in total output. So, in the first case the change is 10 and 19. So, difference between them is 9, and here the total output change is 1, 9 divided by 1, 9. Then difference of 19 and 27 is 8, 8 divided by 1, 8. So, this is how you are calculating your marginal cost. And again you can see this, the marginal cost is decreasing initially, right. Up to this point it decreases, but thereafter again it has started increases, right. Up to this point it is decreasing, and in this case it has increased. So, if you will draw the marginal cost curve, again this marginal cost curve is of U shape, stating that when there is an increase in the output, initially this marginal cost curve will decline and then thereafter it started increasing, right. So, this is how we represent our marginal cost curve. So, let us start with short run output cost curves, right. The basic understanding which we have made about different costs was because of understanding how we are going to relate our cost and output curves in short run as well as in the long run. As we have already understood, we have different time frames in the business. We have short run and the period which is not enough for the producers to change to a new situation, that is being considered as in short run period. Whereas long run is a planning horizon where we can plan out our activities, because there is no concept of fixed cost in the long run, right. So, first we are going to understand how these cost curve will help us to make our production in the short run. So, cost output relationship can also be shown by the graphs, and it will see that average fixed cost curve falls as the output rises from the lower level to the higher level. Let me make it more clear to you with the understanding of this graph. Here we have represented all the cost altogether. This is the average fixed cost curve. If you guys remember, we have discussed that average fixed cost curve will always decline whenever there is an increase in the output. Then this is our average variable cost curve, which is again of U shaped. Initially it decreases and then thereafter it increases, right. Then we have average total cost, which is again a U shaped cost, okay, but this will always be more than average variable cost, because average cost is the summation of average fixed cost and average variable cost. And here we have marginal cost also. Marginal cost curve is also U shape. Initially it declines and thereafter it started increasing, right, and it is the cost of producing one additional unit. Now, let us look at the relationship between these costs. Here we have first we will define the relationship between average variable cost, average fixed cost and average cost. So, how these costs work? So, very first point says that initially our average variable cost is decreasing, our average fixed cost is decreasing, therefore, our average cost will also decrease. Why? We are trying to understand how these costs work, what is the relationship between them. This is how we basically draw the curve, right. This is our average fixed cost curve, right. This is our average variable cost curve and this is our average cost curve. So, here right now we are understanding the relationship between these three costs. So, what we are saying, initially our average fixed cost is declining, our average variable cost is declining, therefore, our average cost will also decline. Then at the second stage we are saying that average fixed variable cost is still average variable cost has started increasing now, but our average fixed cost is still decreasing. So, now what will happen to the average cost? So, here you can see that average variable cost has started increasing, but the average fixed cost is still decreasing, and the rate of decrease, average fixed cost is decreasing maybe by 10% and average variable cost is increasing, but it is increasing only by 5%. So, basically our average cost still declines by the 5% you can say. So, average cost is still decreasing at the second stage. And the third stage says that our average variable cost has started increasing now and average fixed cost is still decreasing. Where now what will happen to the average cost curve? Here you can see that now the rate of increase in average variable cost is more than the rate of decrease in the average fixed cost. Now average variable cost is increasing by 10% and average fixed cost is declining by the 5%. Now therefore, average cost will increase by 5%, right. So, this is how we basically establish the relationship between average fixed cost, average variable cost and average cost, how these cost curves are being defined, right. So, we have seen these properties earlier also that average fixed cost curve will always decline, but the rate of decrease will be different at different stages. Initially the rate of decrease in the average fixed cost is more and at the later stages it declines with the slower rate. Whereas, in case of average variable cost initially it decreases, initially it decreases and thereafter it started increasing, but the decrease the increase in at the middle point is slower and later on it increases with the higher rate, right. And again this is the average cost curve which is the summation of average variable cost and average fixed cost, and why this average cost curve is of U shape, that explanation we have understood here. So, you can say that average cost curve is of U shaped and this is because basically happen because of economies and diseconomies of scale, right. Working at different scale we do have certain advantages and disadvantages. So, average cost curve is a U shaped curve that happens because of economies and diseconomies of scale, and in our next lecture we will cover about economies and diseconomies of scale in detail. There you will be able to understand this concept better. So, for now I hope you are clear with the relationship between average variable cost and average fixed cost curve as well as with the average cost, right. So, I will rub this discussion what we have made here to understand the relationship between marginal cost and average variable cost, right. So, let me draw remove this graph also from this paper. Now, let us look the relationship between average variable cost and marginal cost, right. So, here we have this graph, this is our average variable cost and this is our marginal cost say, right. This is our average variable cost and this is our marginal cost curve. So, how are we establishing the relationship here? Till the time our marginal cost is lesser than average variable cost, right. Till the time our marginal cost is lesser than average variable cost curve will decline, right. When the marginal cost is greater than average variable cost, when the marginal cost is greater than average variable cost, our average variable cost curve will increase, right. Average variable cost will increase, and the point where marginal cost is equals to the average variable cost, you can say this point, right, where they both are equal, this point is called as minimum point. That means the average variable cost is minimum at this point if you are producing OQ output, and this is the price, you can say cost, not price, this is the cost which we are representing on the y axis. Then the cost, average variable cost, not average cost. See, we are talking about the relationship between average variable cost and marginal cost, and to calculate the optimum point we have to establish the relationship between average cost and marginal cost, because this is the individual cost, whereas average cost includes average variable cost as well as the average fixed cost, right. So, to find out the optimum point where your cost of production will be minimum, we have to understand the relationship between average cost and marginal cost. But for now we are talking about the relationship between average variable cost and marginal cost, and here we are saying till the time your marginal cost is lesser than the average variable cost, your average variable cost will decrease, right. When the marginal cost is more than the average variable cost, then average variable cost curve will increase, and at the point where they both are equal, that point would be considered to be as an minimum point where the average variable cost will be minimum. And in the same way we can also define the relationship between average marginal cost and average cost to find out the optimum point, right. So, how are we going to establish the relationship between average cost and marginal cost? Again, let us draw the curves of average cost. This is the average cost curve, and let us draw the marginal cost curve also. So, here again what we are saying, till the time the marginal cost is lesser than the average cost, okay. When marginal cost is lesser than the average cost curve will decline, right, average cost will reduce. When the marginal cost is more than the average cost, then the average cost curve will increase. See, the marginal cost is more than the average cost, and average cost will start increasing. And the point where marginal cost is equals to the average cost, there that is the point which is called as optimum point. Now, this is the point which is called as optimum point. You can write name this point with E. So, producing up to this level, your cost of production will be minimum, right. If you are producing OQ output, your cost C will be the cost, OC will be the cost for producing OQ output, and this is the minimum cost of production, right. Here in this you can see this relationship I have written here also for your better understanding. This is your marginal cost denoted by this dotted line, and here we have this average cost, and what we are saying, till the time your marginal cost is lesser than AC average cost, your average cost curve will decline, and when it is more, the average cost curve will rise, and at the point where they both are equal, that is the minimum point which is called as optimum point, right, optimal point, and producing up to this point our cost of production will be minimum. So, for shorter run we calculate it this way, how and up to what quantity we should produce, so that we would be able to produce at the minimum cost. Okay. Moving ahead, we have long run cost and output relationship. This we have studied about the short run, how in short run we can reach up to the optimum point. Now, let us look at the long run cost and output relationship. As we all know, long run is a period which is good enough for us to change our situations, right, and we have already understood that in long run we do not have fixed cost concept, right, because each and every cost can be changed, we can vary them. So, no cost is fixed in the long run, we have only variable cost. So, till now we have studied that average fixed cost is equals to average plus average variable cost is equals to the average cost. This is what we have studied in the short run, but now here we can see that we can say that average variable cost is equals to the average cost. So, rather you call it as an average variable cost or the average cost, it is almost same because they both are equal and there is no concept of fixed cost involved in the long run. Okay. So, this is what is basically we are going to start with. Long run period, like I said, is enough for all the cost including the fixed costs which are short in the long run. Now, they are they can be varied, right, we can increase them. So, in short run variation in output are only possible with the range permitted by the existing fixed plants as well as equipment. So, if you want to increase the size of output in the short run, you can increase up to a certain limit, right, beyond that you are not able to increase your size of capacity, but certainly in long run the entrepreneur has before him several alternatives which includes construction of various kind and size of plants, right. So, in long run you can definitely stretch yourself and you can produce more, right. So, in long run we have no fixed cost since firms have sufficient time to fully adapt its plant and all cost becomes variable, right. Now, let us look to the characteristics of LAC curve, how we are going to understand the properties of LAC curve. Let us first look at the LAC curve, how does it looks like. See, this LAC curve, this is your LAC curve, the long curve which we are able to see here, right. This is basically the combination of various short run average cost curve. I hope you have understood that this is your average cost curve. So, here this is the first average cost curve which we are denoting with SAC1, then we have the next average cost curve which we are denoting with SAC2, and then we have this third curve which we are calling as an SAC3. So, these are the different short runs average cost curve, and when we combine them together, right, we will able to draw this long run average cost curve. Long run average cost curve is basically the combination of various short run average cost curve, right. So, let us look at the properties. What we are saying that LAC curve is tangential to various SSE curve. Tangential means it will touch, right. Whatever the SSE curves we have drawn for our business purposes, LAC curve will be tangential to our SSE curve, and LAC curve will always be a U shape, right. This curve which I have shown you will always be of U shape, right, and this is again because of economies and diseconomies of scale. Initially when we increase the size of our output, our cost reduces, right, and why does it reduce, what are the reasons behind the reduction of the cost, covering in the next lecture, right. But if you are continuously increasing the size of your output, your cost rather than reducing, it will start increasing, and this gave it's a shape of U, right, it is like a dish shape, right. So, that is why we are saying LAC curve is of U shape. Then we are saying that LAC curve will never intersect, that we have already understood that LAC curve is always tangential to various SSE curves, it will never cut, right, it will never cut your SSE curve, it will always touch it, and it also touches it at different points, right, like LAC curve will touch the various SSE curves at the middle of the center, right, where your you have the optimum point of this LAC curve. C2 is the optimum point of LAC curve. So, here it is going to touch your SSE curve, and it is also going to touch it on the optimum point of SSE1, the left of optimum point of SSE1 and the right of optimum point of SSE3, right. At 3 points it is touching the initial plant optimum point, left to the optimum point of the initial plant and right to the optimum point of the last plant. So, these are some properties we have for the LAC curve. As you can see, for each and every curve we have the optimum point with the combination of average cost and marginal cost, and that is why we have drawn here this long run marginal cost. And as we all know, where our average cost is equals to the marginal cost, that point would be the optimum point. Okay. So, you can say that C2 is the point where your LAC is equals to LMC is equals to SAC is equals to SMC, as because this C2 point is also the optimum point for SSE2, the second plant, right. The second plant is also having this optimum point which is named here as C2, because C1 is the optimum point of SSE1, C2 is the optimum point of SSE2, whereas C3 is the optimum point of SSE3. And if we are combining them together and we draw this long run marginal cost curve, then again C2 is the optimum point for long run average cost curve. This is how we define it. C2 is equals to LAC at this point, your long run average cost is equals to the long run marginal cost, which is also equals to your short run average cost and short run marginal cost, right. So, this is how we basically define the long run average cost curve. I hope the properties are clear to every one of you and you have understood it well, how we draw this long run average cost curve. So, if you look at the optimal plant size in the long run, what is the optimal plant size, right? How we are going to make our production in the long run, like we have find it out our optimum point in the short run, up to which level we should produce so that our cost of production will be minimum. Same is the case, we are trying to find out the optimal plant size in the long run. As I have already told you, conceptually the optimum size of a firm is one which ensures the most efficient utilization of the resources, and in other words, optimum size of a firm will be one which minimizes the long run average cost, right. The point where your average cost, long run average cost is minimum, that point would be known as the optimum point of your long run curve, right. So, here as we have seen, the optimum size consists of at plant 2, that is SSE2, and we can say that our cost is minimum at C2 Q2, right. This is how we have written here C2 Q2. If you are producing up to OQ2 output, right, your cost will be C2, and this is the minimum cost, because if you are producing more than this, then also your cost will increase. If you are producing lesser than this, then also your cost is increasing. So, it is always advisable for you to produce up to that point where your average cost is minimum, right. So, these are the explanations which are being given here, which we have discussed already, and like I said, at LAC curve we are saying that C2 is the point where LAC is equals to LMC, which is again equals to SAC and SMC, right. So, this is how you are going to understand the optimal plant size in the long run, right. So, by now we have understood how we are going to find out the optimum point in the short run as well as in the long run. The only thing which you have to remember here is where the average cost is equals to the marginal cost, either in short run as well as in long run. In short run we denote it with SAC and SMC, whereas in long run we denote it with LAC and LMC, right. So, you have to find out where these two costs are equal, and that point will be the optimum point, and if you are producing up to that point, definitely our cost of production will be minimum, and that is the basically we are doing to find out so that we could be able to minimize our cost. Okay, why are we working for this optimum point? Because we have already talked about how important it is for the business houses to work on reduction of their cost, because we are not left with the choices of increasing our prices in the market because of the competition. So, we need to be very careful while producing our goods, right. Moving ahead, let us look at the usefulness of LAC curve. Now, what is the business implication of this LAC curve and how it is also helping us in planning, right, because LAC curve is also called as planning curve. It is not only helping you to find out the optimum point up to which you should produce, whereas it is also helping you to plan out your activities for future, how much plant size you would be needing, or you should rather go with your existing plant size for your capacity of production, right. So, this also have a business implication. Let me help you to explain this. See, one thing which we need to understand here is we are not going to produce always on the basis of this optimum point, rather we produce our goods on the basis of demand, as we all know, right. If the demand of your product is more in the market, will you produce up to the optimum point only because your cost of production is minimum? That is not possible, right. If the demand of your product is more in the market, definitely you will produce more, and if the demand of your product is lesser in the market, then again you will be producing less, right. So, let us look at this LAC curve once again and how this LAC curve is helping the business to plan out their production capacity. Let us assume that not assume, this is fact that C2 is the optimum point, as we have already discussed. Up to this point if you are making a production, because this is the point where our LAC curve is equals to LMC, right. So, this is the optimum point, but if we have to produce lesser than optimum point, or if we want to produce more than the optimum point based on demand, then how are we going to make a decision? Suppose if we have to produce lesser than this, I want to produce the quantity up to OQ1. So, how are we going to produce this? What we have done is, I have drawn this straight lines toward this these curve, that is SSC1 and SSC2. This is your SSC1, this is SSC2 and this is your SSC3. So, to produce up to this quantity, I have drawn this straight line, and here you can see this is point A and this is point B, right. So, if I am producing it with SSC1, my cost of production will be more, and if I produce it with only this SSC2, by underutilizing it, my cost of production will be less. So, this is how this LAC curve is helping me to understand whether I should overutilize my existing plant size, or should I go ahead with the next plant, or should I add a new plant to my business where we should be utilizing it or underutilizing it or overutilizing it, so that our cost of production will be minimum, right. So, this is how this LAC curve help us to plan out our business activities. Now, if you look at the topic for our review today, we have talked about cost, what cost is, what are the different classifications of cost. We have understood the concept of total cost, total variable cost and total fixed cost. Thereafter, we have talked about average cost, average variable cost, how we calculate average fixed cost, what is the concept of marginal cost, and we have also seen the relationship of cost and output in short run as well as in the long run, and how we will be able to reach up to the optimum point. So, this is all for our today's discussion, and these are the reference books for this lecture. Thank you all of you.